All right, so I wanted to just go over some of the action today and show how the short covering or accumulation was done in advance. Upper left-hand corner, you have the daily. What does the daily do? It goes down to a support level. What's the support level right here? I'll put a circle on it right there. That's the support. How do you know? You have basically a block of overlapping bars and then an increase, meaning the markup. So this must be the accumulation area. Down, down, up, boom, up. Right? So it goes into that area. As it goes into that area, and you see the point and figure also gave a decent projection of where it would go. It predicted, I don't know, 14 and went 12 X's. I mean O's or whatever. So the count was pretty accurate. And in certain markets, that's the way it is. The counts are, what I'm seeing is they're pretty accurate. But in markets that are like more whippy, that are not as thick, those are the ones where you have a little base but a lot of movement. So the markets that are thicker, I think probably will see, it seems that PNF works a little bit better. Anyway, so I think this is where Powell spoke around here, or somewhere around there. But you see the covering happened, accumulation or covering before the morning. And you see biggest volume, biggest price, 47, 49 waves. So what's that telling you? That means they took the position in advance and I think and planned for it to go up. Because you can see, and this is a very popular pattern. I'll explain. Typically, before change of behavior, you get this. You see that? The decreasing volume. After that, you got a change of behavior, and what happens in the pullback? Nothing, 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 effort, boom. All right, so this is very key data, meaning the background of supply diminishing like this. Because let me tell you what the real law of supply and demand is. All right? The real law of supply and demand is as price goes lower, supply decreases. Again, as price goes lower, supply decreases. Why? Because the prices are worse for selling. For selling, you want high prices, not low prices. So as price goes lower, supply or selling will decrease because they're getting worse and worse prices. But you know what increases as price goes lower? Demand. So the law of supply and demand, what it really is that low prices, you have a lot of demand. High prices, you have less demand. And vice versa for supply. High prices, you have increased supply. Low prices, you have decreased supply. So, that's common sense, and it's also the actual thing you'll find on Google or in, economics. You'll find the graph, which will, something like this. And talk about an equilibrium in the middle. And draw like that. There'll be a y-axis and a x-axis. What is it saying? What goes down as price increases? This we'll call price on the x-axis. As price increases, what goes down? Obviously, demand. And as price increases, what goes up? Obviously, supply. So price is increasing, what goes up? Supply. Price is increasing, what goes down? Demand. And the y-axis here represents volume. That's it. So as price increases, the volume, supply volume, or whatever you want to call it, supply increases, demand volume decreases, right? So now, just keeping that in mind, you're noticing price go down, 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 down. What's going on with supply? As price decreases, as price decreases, supply, what happens? It's this way, it's down, right? Increases, it increases. As price increases, supply increases. As price decreases, supply decreases. So as price is decreasing, the natural behavior, and I mean the natural behavior of a market, any market, doesn't only have to be stock market, it could be any market where you have buyers and sellers. This is the normal behavior of supply. The red going down as price goes down, and then what happens when price goes down enough? Demand comes in, right? Demand comes in when price is low. There you go. And this is exactly what's in your economics books and all that, but they just draw like an equilibrium and things like that. But the common sense is supply obviously is going to decrease as price goes lower because you're not getting high prices to sell. And if price goes lower, you're eventually going to have demand step in because they're buying on the cheap. So that's what they do, buying the cheap. And that's your demand. And it's so obvious, the biggest price wave in 47 waves, at least biggest volume in at least 49 waves. And that's this. Price goes down, demand goes up. Price goes down, supply goes down. Why supply goes down? Because you get bad prices to sell. Because prices are low, you want to sell when prices are high. Demand goes up because prices are low, they're cheap, right? So that's one important thing. And the other thing I want to mention, and I'm going to show this, is some key thing about springs and upthrusts and how they really work. All right, now you've all seen this model, this stupid model of I hate models because they're so fictitious, and schemas as well, because they don't work. You see this? Higher high, higher low. This is not reality. Show me any market that does this. I would love to trade it because it'd be the easiest thing to make tons of money, and I think we all know that. So what really happens is and this is how springs and upthrusts work. You have a probe. Pay attention, folks. This is the real deal right here. You have a probe. A probe is a slightly higher high. This slight higher high, there's a couple of interpretations. One is that it's a probe. The other is that it cannot go higher because there's no liquidity. So there's a hunt for liquidity which leads to the spring. It doesn't matter what you believe, it just, the fact is, it cannot rally, but it makes a slightly higher high. Okay, so that slight higher high means that they checked above this area to see what's there. Now they will hit this area, the spring. Right? Let's call it a spring right there. And then take the market up. So this is the reality. You have a move, and then there's some type of slight higher high which probes that area, then comes back down to run the stops for whatever reason. My opinion is that the reason why they go here is that this is the quickest form of accumulation. Because if you go into a range, it's going to take too long to accumulate. So it's easier just to hit the stops and accumulate. So that's what they do. Then they go up. And the same thing for the downside, meaning up thrusts. Alright? Now I'm going to prove this to you just using any chart. Doesn't matter what chart, you're going to see that this is the situation. Alright. And on different time frames too, but okay, so you see here below they make a slightly lower low right here. Alright, right there, slightly lower low. Does it have follow through? Does it continue lower? No. So this is a probe. Now, what do they do now? Lo and behold, up thrust. So probe below, up thrust above, and then puke. Alright, now we'll do it again. So this is the low. What happened here? Probe below, then up thrust above, and then puke. This one had follow through. This one looks slow, Now it had the probe below and another below, so I'm expecting it to come up, take out at least one of the highs. But what it does is that it has a change of behavior. So, if they probe below like this, then either one of two things. Usually it's just up thrust or test and then continuation. But in certain situations, obviously, eventually you have a change of behavior. And that's what happened here. Now we're going to see the long side. So you have to just look. Probe above, right? It could be any wave. It could be an inside wave or it could be above the rally. Doesn't matter. Here it's inside. So they finally make a probe above, then takes out the low. So probe above, spring below, and there she is. Go. You see, this is the real movement of the market. It's not higher high, higher low. In my opinion, I don't think that's the real movement. And I know, like, on the internet they say, oh, there's internal trend and external trend and all that shit. But I think that the way the market moves, it probes an area, and at that point, if it cannot go higher, it will probe it, and then it'll go and accumulate the stops. And then once that's done, it's ready for the move. This is the real way the markets move. And if you want, I can show this all over. there's always, the key is that it has to look like a shortening of the thrust, meaning, or you know, like a spring or up thrust. It's just like a little probe, and then it does this, and you will see this repeatedly on any trending market, that this is the reality of how the movements are. And I think this is also the case with thicker markets, because they're more difficult to move. Thinner markets, you know, have that more trend-like, you know, if you compare the Russell to the ES, for example, you'll see that the Russell has more trendiness, because I guess because it's small cap. But this is the natural movement. The springs and the upthrusts after the probes is very, very, very common. All right, I'm done. Take care.